GT probably asks, I'm turning 40 soon and I just discovered the foo. What debt interest percentage is considered high interest debt? And I know we have some thoughts on like what age you are. And so can you kind of iron that out for him since he's new to the financial order of operations?
Yeah, we get this question a lot. What's interesting is there are some types of debt that are objectively high interest. The one that most immediately comes to mind is like credit cards. If you are carrying a credit card balance and you 10 years ago were paying 12% interest, but now you're paying what, 23, 24%? We've seen some as high as 30% interest rates on your credit card. I don't care how old you are, where you're from, what you got going on. That is high interest debt. That is a no-go land. It does not make sense. But there are other types of debt that you may have where at different stages and in different phases of life, it might be categorized as high interest or not categorized as high interest. Some of the common ones we talk about, Brian, are like student loans. There are times when student loans may be high interest or low interest. And even we've talked a little bit about mortgages. There are times when it makes sense to prioritize prepaying mortgages and times when maybe it doesn't make sense to prioritize.
Yeah, but I do want to be clear. I think this is a great question that GTA offers, and now I'm more inclined to think that they probably are a Georgia Tech type person. Just because this is a nerdy question, but it's a good question.
They're 40, so they might not be thinking about going to Georgia Tech.
I was just trying to give a compliment to the Georgia Tech to bring it back because I called them nerds. When we've really thought of this, there's two components that went into it. And it is unique because interest rates right now on your cash, you can get 4 and 5% pretty easily. Mm-hmm. And why that's important is because what you make on your cash is considered the risk-free return. This is, if you can just go buy something and get 3, 4, 5% without taking on any risk, that's pretty incredible. Mm-hmm. Well, that's why to obviously take on more risk or to go invest the money and not be guaranteed you'll get the money back, there's what's called a risk premium. And I've always tried to pay attention to, that should be a spread. You basically take the risk-free rate of return, you add the risk premium, which historically has been around 4%, depending on which time period you look at it. So it was easy to say, and I'm going to give you these numbers, but know that it's been changed a little bit, and then also give you a caveat on this. That's why when we talked about student loans, we've always said if you're in your 20s, it's okay if you still are funding your Roth IRA as long as you're not paying more than a little over 6% on your student loans. If you were in your 30s, that number dropped down to 5%. In your 40s, it was 4% because there was also the balance of risk premium, but there's also a desire to get you out of this debt fast as possible. So that all seemed great while interest rates were less than 1%. Mm-hmm. It was so easy to give that guidance, but now that we're at this new interest rate, and it's a temporary thing because there's already pressure for the Federal Reserve to start lowering rates at some point this year. So I think we'll go back to a lower number that makes this all work much easier. But I do want to put the caveat that I think that mortgages, even though they can be 6.5%, even though as high as 7% currently, I'm hesitant to immediately say because it's over 6% that is high interest debt. I think that it's a moment in time that will be refinanced or other changes will happen that I don't know that I'm willing to throw out all of my rules, all of the guidance for this moment in time and have people not funding their Roth IRAs or building their emergency reserves because they, mortgage rates are at 7%. I'd rather you be more of a balanced approach, a more averaged out over the time frame, and know that it's still probably a step 9 because you're going to have that opportunity to refinance or make changes in the future. Well,
that's what I was going to say. Even as you think about debt, because he put some additional context, he's considering debt between like 4% and 6.5%. Didn't say what kind of debt. I would argue that how you approach that and how you think about that is a little bit dependent on where you are in your financial journey, right? If you're 40 and you are still early on and you're still in steps, 1 through 7, you're still building, then that's going to cause you to arrive at a different conclusion that maybe building dollars and getting money to work for me and continue to establish my foundation is the most important objective right now. But if you are farther along in your journey and you have built up a substantial base and you are in one of those advanced steps, you're in step 7, 8, 9, well, then you get to choose. You get to actually make the decision around, okay, do I want to utilize my dollars to satisfy debt or to knock out that 4 to 6.5%. So you'll have to define the type of debt that you have, the interest rate that's on that debt, and where you are in your journey to determine the most appropriate way to attack that.
What you just described, and it's great because GT is turning 40, and that's a very big, kind of a transition point, is you got to know where you are. Are you ahead of the curve, behind the curve, or right where you need to be? Go check out our Know Your Number course.
Great.
And then you got to financially do triage to know, because that's the part. If you're a person who's never invested and you're 40 and you're making a decision, do you pay down debt or invest? That's where you do run into a problem. Is it's easy to say pay down the debt if you have a lot of money behind you, but if you have never invested and you've never done your financial triage is probably going to say, man, we need to get some money in a Roth IRA. Right. So that's why it's very personalized. They put the personal in personal finance and kind of take your financial triage between a net worth statement and Know Your Number course to kind of figure out where you fall in that and what the next step is for your army of dollar bills.